Imagine trading in a market where every second counts, and the cost of each trade can make or break your strategy. Welcome to the world of Forex trading. In the Forex market, the spread is a critical factor that determines the cost of trading for investors. The spread is the difference between the bid price and the ask price of a currency pair. Understanding how Forex brokers determine spreads based on market liquidity is essential for any trader. Market liquidity refers to the ease with which an asset can be bought or sold without affecting its price. High liquidity in the Forex market typically leads to tighter spreads, meaning the difference between the bid and ask prices is small. Conversely, low liquidity often results in wider spreads, increasing the cost of trading. Forex brokers adjust their spreads primarily based on the liquidity of the currency pair being traded. Major currency pairs like EUR-USD, GBP-USD, and USD-JPY are known for their high liquidity. These pairs are heavily traded, allowing brokers to offer very tight spreads, sometimes as low as 0.1 to 1 pip. Minor and exotic currency pairs like USD-TRY or GBP-ZAR are less liquid and often have wider spreads. The Forex market is open 24 hours a day, but liquidity varies depending on the time of day. The overlap between major trading sessions, such as the London-New York session, is typically when liquidity is at its peak. During these periods, brokers can offer tighter spreads due to the higher volume of trades. In contrast, during less active trading hours, such as the Asian session, liquidity decreases and spreads widen. Stable market conditions generally support tighter spreads, while volatile conditions lead to wider spreads. Market makers set their own bid and ask prices and adjust spreads based on market conditions and liquidity. ECN STP brokers pass clients' orders directly to the market, offering spreads based on the best available prices. Scalping involves making numerous small trades to capture tiny price movements, relying on tight spreads. Day traders benefit from tight spreads, but must be mindful of when they trade to avoid wider spreads. Swing traders aim to capture larger price movements and are less sensitive to spreads, but must still be aware of liquidity changes. Central bank policies, such as interest rate decisions and quantitative easing, significantly impact market liquidity. Geopolitical events, like political stability or tensions, can lead to sudden shifts in liquidity and spread dynamics. Economic indicators, such as GDP growth and inflation data, also affect liquidity and spreads. Traders' risk appetite and speculative trading can either increase or decrease liquidity, impacting spreads. Technological advancements, like algorithmic trading and advanced trading platforms, contribute to increased liquidity and tighter spreads. Trading during periods of high liquidity, such as the overlap of the London and New York sessions, can help traders take advantage of tighter spreads. Selecting the appropriate currency pairs that match risk tolerance and trading goals is crucial. Monitoring economic calendars helps traders anticipate changes in liquidity and spread dynamics. Utilizing stop-loss orders protects against sudden spread widening in volatile markets. Choosing a reputable broker that offers competitive spreads and transparent pricing is essential for successful trading. Understanding the dynamics of market liquidity and spreads can make a significant difference in trading success. Keep trading smart, and may the pips be ever in your favor.